Take a look at this chart. It shows the S&P 500 during the last two major recessions. Now look at this one. It shows the average price per square foot of residential real estate in Dubai during the same periods. Looks scary, right? But what if I told you that there are several types of real estate in Dubai that not only survive recessions, but can also keep generating cash safely or even grow in value while others are losing money? And with the first property type we're going to talk about, it's almost impossible to fail. We call them value gap properties, and I'll even share a couple of opportunities you can invest in right now. But before I tell you how to find one, let me explain what a value gap property is. This is property number 1. You could buy this for 1.3 million US dollars. And this is property number 2. It's very similar to the first one, but it's much cheaper. You could buy this for $700,000. I know it sounds too good to be true, but bear with me. Now let's imagine the market crashes. A big bank goes bankrupt, investors start to panic, and markets go down. And suddenly, the value of properties like this dropped to $1 million on average. But the second property was even cheaper than that, so it will go against the trend and will keep appreciating even though everything is falling. Most people think that for these kind of properties you need to look for distressed deals. By distressed, we mean the properties where the price has been reduced because the owner urgently needs to sell. In most cases, it's because of financial difficulties. But there is one problem. A distressed deal hitting the market is like throwing a steak into a pool full of sharks. And the really good steaks won't even make it to the pool. So it's almost impossible to find a great distressed deal on the open market. This is the moment when some of you will go to Property Finder, type distress in the keywords, and get 500+ results. Good luck with that approach. First, because many of those properties aren't actually distressed, they're just normally priced. Second, some are fake. You call the agent and they tell you it's just been sold. But there is another unit that's even better, but priced a bit higher. And third, some might actually be underpriced and the owner may be in a rush to sell, but the deal doesn't make sense as an investment. But there is a way to find great value gap properties among new off-plan launches. They are typically hard to find because off-plan properties are often priced close to or even higher than the ready ones. Developers will justify this by telling you that it will be of great quality and will have amenities unlike anything else before. And when the market is growing rapidly, that might make sense. But let's be realistic. When growth is uncertain, these assumptions are just risky. So to be safe, you should buy a property that's priced dramatically lower than what's currently on the market. And these deals do exist. Imagine you're looking for a ready apartment in a boutique building with a private beach. Your choices are pretty limited. Ignoring the ultra-luxurious segment, the best of what's available would probably be Ellington Beach House. A one-bedroom there is priced at 1.3 million US dollars, and right now there are deals for between 1.4 to 2,000 US dollars per square foot. So now you look for an off-plan property with similar features to this one. You might find a project on Dubai Islands on the first row with a private beach and less than 80 apartments in total. And it's priced at just $850 per square foot, so it's 2 times lower. And of course, it's not like the prices will double overnight. Dubai Islands is a different area and won't be fully developed for a few years. But when the value gap is that big, you have a high probability of success. And even if the market drops, there is likely to be significant growth by handover. And here's one more example. The gap isn't that huge, but an investment like this would have an even more predictable return. Look at this chart. The first bar illustrates the average price per square foot for villas and townhouses in Jumeirah Golf Estates. The community is great, but most of these properties are quite old. And the second bar is a new cluster of townhouses that was handed over not long ago. The price on the secondary market is more than $100 higher than average. And here's the third bar, with the price of off-plan twin villas available right now. They're not just cheaper than the newest cluster, they're priced even lower than the average in the rest of the community. And if you're looking to invest in real estate like this, reach out to us. I own a real estate advisory and brokerage firm, and we're constantly monitoring the market and know all the value gap properties available in Dubai. We support all of our clients end to end. First, we do the personalized property selection based on your investment goals and restrictions. Second, we help you prioritize based on data and financial modeling. Third, we ensure you purchase the best unit possible. And fourth, we help you make money on it. So call or WhatsApp us, scan the QR code, or click the link in the description to get a free consultation with my team. By the way, these value gap properties in Jumeirah Golf Estates we just talked about are villas. And these are the number 2 on our list. Villas and townhouses are one of the most reliable property types in an unstable market. To demonstrate how well they survive a crisis, let's look at how they've performed in actual downturns. Here are the average rental rates for apartments in Dubai. The highlighted section is the COVID period. During this time, the average apartment rates dropped by 27%, but villas only declined by half of that, 13%. And even if we set the crisis period aside, villas are on average growing 2 times faster than apartments. Between 2022 and 2025, apartment values grew by 30%, but villas and townhouses appreciated by a massive 64%. Okay, but what about the areas where apartments are doing really well? Is paying for a villa still worth it? I can answer this by showing you Dubai Hills. Apartments there have outpaced the market with a 50% price increase since 2022. But villas and townhouses in the same area are performing even better. They had a 63% growth. So yes, often, even in high-performing apartment locations, villas are even more successful. And even when a villa under-delivers, it's still a good result. Here are 3 areas where villas didn't perform that well. There is District 1, where they've grown by 39% since 2022. Then Arabian Ranches 2, where they grew at 51%. And also Falcon City, where there is nothing really happening for a long time. They've shown a 63% growth. These numbers might be considered low for villas, and yet they're still higher than most apartments in Dubai. However, there is a downside. Villas can be quite expensive. Typically, you'd need at least $1.5 million budget to invest. So maybe you want this kind of stability, but without making such a large investment. Then I have a good news for you. There is a cheaper property type with a similar recession resistance. Number 3 on our list is bigger apartments. Just like villas, bigger units perform better than smaller ones during a crisis. Let's look at the numbers. Again, we'll compare the rental rates. For 3 beds with 1 beds during the COVID crisis. In Business Bay, 1-bedroom rental rates dropped by 25%, but 3 beds went down by just 16%. In downtown, 1 beds dropped by 20%. Compared to 8% for 3 beds. And if you're still not convinced, look at Dubai Marina. 1 beds dropped by 31%, while 3 beds decreased by only 4%. So why is this? Because bigger units are typically rented by families. Resident families are the most stable type of tenant. They take time to choose, but once they move in, they tend to stay. And the value growth for these bigger units is slightly faster. Since 2022, 1 beds in 13 major Dubai neighborhoods have grown by 45%, while 3 beds have increased by 52%. Unfortunately, there is a trade-off. Rental yields are 1 or 2 percentage points lower for bigger units compared to smaller ones. But generating better returns during a recession isn't just about the size of the unit. It's also the location. Let's talk about another investment strategy that rarely fails. Buying in a master community. Number 4. Master communities by strong developers. And to avoid generalization, I want to say that many master communities will not succeed. I'll tell you how to sort out great from the weak soon. But first, let me show you how Emaar master communities performed between 2019 and 2021. This period began as a COVID downturn and then prices bounced off the bottom. This is Dubai Hills. Villas values increased by 20% and apartments grew by 26%. And this chart shows the data for Arabian Ranches 1 and 2. They increased by 35 and 37%. At the same time, the overall market showed just a 12% growth. And even if we check how Emaar master communities generally perform, there is a clear pattern. The first bar represents the average apartment value growth in Dubai, and the next 6 bars represent a different community built by Emaar. Their communities consistently outperform the market, and this isn't a coincidence, it's intentional. Because Emaar controls what gets built, when and at what price, they also control how property values move. Here's how it works. They announce their first building, and they price it at $550 per square foot. Then they announce a second. It's just as good as the first one, but this one is $600 per square foot instead. So what happens then? The price in the first building rises to meet the second. Then they announce a third building, with slightly higher prices. And then a fourth, and the prices all go up again. As you can see, it's a system they use. And investing in such properties significantly reduces the probability of failure. It doesn't mean these properties won't feel the recession in any way, but they'll be among the fastest to regain their value. So many investors have realized how strong master communities can be, and a dozen of Dubai developers have started building their own master communities. And they use them as a key reason to invest in their properties. But in most cases, this won't work like it did for Emaar. Here are 3 reasons for that. First, the Emaar communities are exceptionally good. They've all got unique and highly desirable features. Like Dubai Hills, it has a massive park, cafes, fine dining, and a large mall, all integrated into a walkable community. And if you look at other developers, their infrastructure is significantly more simple. Emaar has a competitive advantage. They own several subsidiaries that specialize in building and managing malls, entertainment facilities, retail, and hotels. The second reason is that consistent price increases will only bring significant long-term results if the community has a huge scale. Small master plans often hit their limit after 3 or 4 launches, when they run out of space. But Emaar builds communities that can keep evolving with new launches for many years. I'll use Dubai Hills as an example again. It launched more than 7 years ago, but it's still growing. Emaar can keep raising prices with each new release, and the early investors benefit from that all the way through. The third is the strength of their brand. Investors are getting in line for Emaar units before any building pictures or amenities lists are released. Emaar keeps launching new communities, so you'll have a chance to enter something at an early stage. For example, Oasis has a huge master plan, and they've only sold a small fraction of what will be built there. They also recently launched Grand Polo Club. As of now, only the first phase has been sold, so there are still plenty of opportunities. Emaar is a standout, and its example illustrates how important it is to choose the right developer. When the bad times come, you want your money to be safe with a developer that consistently outperforms the market. So here are some examples of developers that never fail. The first developers building almost always outperform their area's growth. I'll show you what I mean with an example. Let's look at the value growth in GVC. The average apartment has grown there by 27% since 2022, which is quite close to Dubai's average. Now here are 6 buildings built by this developer in GVC. All of them except for one grew far faster than GVC's average. The average growth for these developers' buildings is 38%. That's 1.4 times higher than an average apartment in that area. The developer behind these buildings is Ellington, and the main reason for their value growth is the quality of the buildings themselves. They make visually appealing designs with great layouts, they're well planned with no wasted space, and lots of storage. When we help our clients to purchase a unit in an Ellington building, we can be sure there won't be any unexpected issues. Quite soon they'll announce the first phase of a new project in a very strong location. We cannot say anything else until the official launch, so if you're interested in Ellington and want to secure a great unit before the project becomes crazy popular, we can help you. Drop us a message and my brokers will make sure you get it. The second developer that never fails is quite boutique. Compared to Ellington and Emaar, they're operating on a much smaller scale. But despite this, every project they've delivered has shown a strong rental income. Here are 6 of their buildings, with all the apartment types and their current rent-to-price ratio. We calculate this by taking the average rental rate and dividing it by the current property price. You can see that every size of apartment is bringing in a decent return. So let's make it easier and take the averages. These numbers are good, but not exceptionally high. But there is another factor we should consider: the rent-to-price ratio based on the original price investors paid to the developer. This indicates that investors now return 10.5 to 13.8% on their investments in gross revenue on a yearly basis. And the developer behind these buildings that ran so well is Iman. Iman was founded in 2016 and has built just 8 projects since then. The quality they deliver at their prices is really rare. You can see it in every detail, from the public spaces like the lobbies and elevators to inside the apartment, right down to the tiles they use on the bathroom floor. Besides the great rental returns, Iman's properties can also show exceptional value appreciation too. For example, Oxford 212 in GVC. The average price per square foot in this building has grown by 67% since 2022, while the GVC average is 27%. That's a huge value appreciation rate for such a short period of time. Iman doesn't launch new buildings very often, but now their main project is Cascade 15 in Motor City. As of now, around 30 units are still available there, starting from around $420,000 for a 1-bedroom. A developer's reputation says a lot, but there is one more basic quality you don't want to overlook. The worst thing that can happen during a recession is having an unfinished unit when it starts. The extra financial pressure means that it's a lot less likely your unit will be completed soon. But there is one way to make sure this doesn't happen to you, and that's to buy from developers that always build on time. Here are 2 examples. The first developer is Bengadi. They are known for building very quickly, and they usually finish a project in 12 to 18 months. This is possible because Bengadi has its own construction arm, designs in-house, and handles most of the development pipeline internally. Even when they've had delays in the past, they were usually small and shorter than you'd expect to see in the market. And the other developer you should keep in mind is Imtiaz. Their track record is still growing because they haven't delivered many buildings yet, but they're vertically integrated and former contractors themselves, so their timelines seem promising. These are just a few of the great Dubai developers, and if you want to know what the 10 best ones are, check out this video.